Key inflation data due out later today. Joining us now to talk about rates in the Treasury market and the James Comey indictment. Priya, Misra. No, not that, right? No, maybe not.
Not the James Comey, no.
Oh, okay.
Not a lawyer.
JPMorgan, yeah, none of us are. JP, we have, you know what? Thank God for those. We have way too many anyway. JPMorgan Asset Management, fixed income portfolio manager. Cross currents. That's what I gathered from a lot of your comments about what is happening. Is it unprecedented? This type of environment? There are certain things here that we haven't seen in decades. I think to try to figure out how do you do it. And what's your conclusion?
So there are structural aspects and cyclical aspects. We're dealing with both right now. This is not the only time in history. So, but it is a very challenging environment. So what are the structural components? Companies are solid. They came into this year with very good balance sheets, with the ability to innovate. Once we know where that tariff world is, what are companies doing? They're trying to absorb as much as they can. They're trying to pass on what they can. But then we've looked at, look at the cyclical headwinds. Interest rates, I would argue, are still restrictive, which is why I think the Fed, is right to start to cut rates. I think what the end point is, there's a lot of debate. What is neutral rate? I think the data is going to tell the Fed. I don't think, there's a lot of division in terms of the neutral rate. There's division in terms of how much inflation, how transitory will inflation be. I don't think they're going to use that word, but they are debating how, is this a one-time tariff shock? So you asked about the conclusion. The conclusion here is have a diversified portfolio. Think about fixed income. Fixed income is giving you income and it's giving you diversification. If the economy slows down, if those cyclical aspects I talked about, higher interest rates, this low higher labor market turns into a starting to fire labor market, the Fed's going to be aggressive. They're going to cut rates. So you get that diversification. If you have the AI trade on, have something that will hedge, something that if things slow down, what will work? Fixed income will work. So that's why we're seeing flows into fixed income. I think there was concern a few months ago, sell America. No, there was some hedge America. There's no sell America. The U.S. is still outperforming on a growth standpoint. So, I think, which is why I think bond funds make sense. I don't want to talk my book, but I think if you own the structural AI, structural strong corporate balance sheets, own some credit, own some duration. So we like 5-year, 10-year, corporate, high-grade corporate paper. Little nervous about CCC high yield, but I think if you're in BB high yield, single B, there's some great companies to own, and you're getting that yield now, given where interest rates are.
What do you think is happening with the labor market? Is it, if we hit bottom and we're re-accelerating, is it possible some of the what you talked about with companies reacting to tariffs? Is it possible that some of it, they react by not hiring as many people?
I think absolutely. I think there's uncertainty around tariffs. I keep being told, well, we know what that tariff rate is. You just see last night, we don't actually know. I mean, depending on which sector you're in, we still have the 301 investigations. So what have companies done when, with all this uncertainty, immigration, they pause. So I think we're in that pause mode. Now, I can see the upside risk. You talk about re-accelerating. I don't think we're re-accelerating right now.
With labor, you don't think we've hit, you think the worst data is yet to come?
I think it's possible that growth slows down, that you could actually move from low firing to pick up in firing. You could also see the pickup in hiring. We do have the One Big Beautiful Bill kick in next year, bonus depreciation. Do companies say, okay, we finally know what to do with tariffs? And then let's start to hire. So I think risks are balanced to the labor market. I don't think we know, and that's why the Fed cut. They're worried about the downside risk to the labor market. I think both the risks are balanced right now.
Priya, we spent a lot of time yesterday talking about the potential government shutdown and the threat from the administration at this point that they would fire a lot of government workers instead of furloughing them and bringing them back. Do you pay a lot of attention to that, or you think it's still noise at this point?
I find all the shutdown, debt ceiling, typically political theater, but it's typically furlough, where I would say that it's a short-term impact. You don't get paid for 2 weeks, then there's back pay. Is this a negotiating tactic? In which case we can ignore it. If there's actual layoffs, we saw the impact of the Doge.
Of Doge, right.
Exactly. So this would be Doge on steroids. So if
And
it
what
does
does that
happen,
what does that mean for the broader implications in the labor market if you have corporations that aren't hiring at this point too?
Exactly. So the private sector is pulling back. If the government does that, I think this is one of the reasons why the labor market outlook is going to be murky. Here's the other thing. If we go into shutdown, we're not going to get the payroll report. Now, people say, well, you can't rely on the data.
Right.
When I look at revisions, if you look at the 3-month revisions, you're getting a lot of data. So we don't have that. We're going to look at all other data.
That's really interesting. We won't get other data as well.
Right.
Well, you go through that. So we're looking at a time where we say the data's not great, but we're already in a fog, as the Fed has said, as Jay Powell has said, trying to figure things out.
Right. So we're going to look at more data, I think, just maybe third-tier, second-tier surveys. And that's where companies are not signaling that they're ready to fire. So that's why I can see where the downside risk might be lower. They're not saying they're going to hire a lot either. NFIB hiring intentions declined, and it's sort of bottoming out. So hopefully it starts to pick up, but we haven't seen that sign. So, but we'll be looking at all of that. But I do think the Fed, where Fed funds rates are, they're going to still cut in October. I think they've told us that they're going to gradually get to neutral. Now, is neutral 3.5 or 2.5? Governor Myron thinks it's 2.5. I think a lot of people at the Fed think it's 3.5. I think that's a debate we're going to have next year. But for now, we're at 4.25. So I think they're going to continue to gradually cut rates.
3.25, 3 3/4 to 4.25 is where you see, after all this, is the range for the 10-year at this point. And I asked you for the conclusion, and you said it. The conclusion is to extend some duration. If you could bank on 3.75 to 4.25, you should be buying something a little bit longer. And you could even go down the. Doesn't have to be AAA either, does it?
Exactly. Right. You can get 5.5 if you go into if you just stay within investment grade credit. You're getting 5.5. Yield.
What if you go to BBB plus? What do you get?
You're getting 6.5.
Which is what long term in an average stock market. That's
Exactly.
about what you can expect. So.